Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we're going to take a look at our potential surprises for 2023 and also touch on what happened in 2022.
And remember, you can email us at feedback@investorhour.com and tell us what's on your mind. That and more right now on the Stansberry Investor Hour. Well, here we are at the end of another year. I feel like it went by in about 10 minutes.
Yes, again. I was thinking about how this year compared to 2020 the other day.
Oh.
That one seemed to distort time. This one just felt a little more dragged on and a little more, in the markets at least, a little more tedious.
Yeah, it did surprise me. Like, I would have guessed that after the biggest financial mega bubble in all recorded history, that it would be a lot crashier, but it wasn't crashy. It was kind of a well-ordered decline with a few little rallies here and there.
Yeah, it was just a steady burn with bear market rallies in stocks, at least.
Yeah.
Bonds, worst year since the pen and quill.
Yeah.
And
exactly.
And a lot of people surprised about what happened with stocks and bonds falling in tandem. But I won't say we could see this coming, but we did write about this in the digest, in the middle of 2021, like stocks are super expensive.
Yeah.
Bonds prices can't really go any lower because interest rates are going to go higher.
Right.
And, it didn't know it was going to be the worst year for like the 60 portfolio, but something like that.
Right. The 60-40. You and I think you and I have pretty good, bearish credentials at this point. So we do get some credit for that going into this year for sure. But still, like, I don't know. Had you ever heard of, FTX and Sam Bankman-Fried before November? I hadn't.
No, honestly, well, yes and no. No, not the details of it, but yeah, probably the only thing I remember is a Super Bowl commercial.
Oh.
With Larry David last year, who, if you rewatch that, it's all about how like ideas that sound a little too good to be true. So,
it's hilarious.
So it actually played out. Yeah.
Yeah.
But that's the most I heard about it. Yes, to your point.
Okay. I think maybe I did know something because I do remember that commercial and, talk about irony. Like, he was supposed to be the fuddy-duddy who didn't get it on that commercial. And the truth is, like, now looking backward, he's the guy who got it right and everything else was wrong. Sort of.
Right.
Don't make a commercial like that. There's too much hubris in that commercial. It was a sign of the top, right?
It was, I think, right?
Yeah.
February 21.
Yeah.
So along with ARK and all the tech names of the past however many years taking a tumble this year, right?
Yep. Yeah, that was like, if you went on Twitter, all the crypto people were saying things like NGMI, not going to make it. You're not going to make it if you're not super bullish on all crypto, and especially like Bitcoin. And there was another phrase, have fun staying poor was the other one. That was too much hubris. It was all a sign. And, like I said, you and I get some credit. I was writing about ARK the day before it peaked, and you've certainly written your share of bearish stuff. So,
I know, which is I don't want to be bearish, to be honest.
Yeah.
But if you weren't kind of preparing for something like this,
right,
I don't think I would be doing my job.
Right. It wasn't about
it
wasn't about making a prediction. It was just about like risk management and recognizing insane valuations and insane speculative activity, which wasn't hard to do, I don't think.
Right. Yeah. I don't either. Yeah. If it was pretty, when you see the price earnings ratios and everything at once, it's happened 3 times in the last 200 years, okay, that seems like something to pay attention to.
Yeah, that's right. So it's like, hey,
let's not make it more complicated than it needs to be.
Exactly. Hey guys, nothing has ever been this expensive ever. Just want to point that out. Carry on, right?
Right.
But one of the things that I have been talking about for a few years, I mean, I was way ahead. I was wrong for years, put it that way. Was I kept telling people, especially at our annual Stansberry conferences, the best companies in the world that everybody thinks are the best companies in the world, they're going to treat you poorly too in the end. They're not going to do well. And we actually had Rob Arnott from Research Affiliates on the program talking about this, the top dogs. And the top dogs are just the biggest market cap companies like Apple, Amazon, Alphabet, Microsoft, Meta, Tesla, all those. Each one of those lost more than 750 billion in market cap from its all-time high, for a combined loss of more than 5 trillion from their all-time highs, reported recently by Bespoke Investment Group. And Amazon recently became the first company to lose how much? 1 trillion in market cap. Like, the first $1 trillion market cap
Wow.
was 2018. It was Apple. And now we're having their first $1 trillion loss in market cap. How the times are changing. Just
That tells you something right there.
Yeah.
Tells you a lot, actually.
Yeah.
Yeah.
A trillion here, a trillion there. Pretty soon you're talking real money, right? I mean,
Yeah, that's right.
all right.
Eventually, dollars. Yeah.
Yeah.
My daughter this morning was talking about, we don't have enough money. We need to go to the dollar store to buy the money. And I was like, it's not a bad way of thinking about what happened in the last 2 years with the Fed going to the dollar store.
That's cute. Kids, huh?
Yeah, they make it
Yeah.
easy.
Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. All right, so let's get on with our list of top 10 surprises for 2023. This is a list of items that we believe would surprise the market. We're not predicting these things would happen, but markets have a way of surprising us, as we've just discussed. And right now, the way things look, we think this list of 10 items would really surprise the daylights out of everyone. And Corey, why don't you start? Because this first one is yours. You came up with this, and I didn't even think of it. So why don't you do top 10 surprise number 1 for 2023?
All right, here we go. My first thought when you guys asked me to do this exercise was, I don't think anybody's expecting a normal year. And by normal, I mean something around average annual return of the S&P 500, which is around 10% in the last 30 years. I think most people, at least in the financial opining space, or a lot of people, are expecting a recession ahead. What does that mean for stocks? Generally speaking, not good things.
Right.
However, we don't know what kind of recession it's going to be. Yes, people will lose jobs, which is nobody wants.
Mhm.
So yes, their earnings will be hurt, but maybe, just maybe, it's not as bad as people imagine. And by the end of the year, we're at, say even the slight gains or that 10% number. Now, I'm not saying it couldn't be volatile in between that. I suspect anything that happens is going to be volatile, but maybe not. Maybe it's more of like a smooth ride ahead, and that would be a potential surprise, I think. So my
Absolutely.
my point with that, yeah, and we can get into why I bring this up, but that's kind of where my first thought was.
Well, it would surprise me, that's for sure. And, you're right, though, to consider scenarios like recession or whatever. Like, part of the thing that is frequently on the lips of Jerome Powell, chairman of the Federal Reserve, is labor market tightness. And we could imagine, could we not, that this labor market tightness, it loosens up not by lots of people being put out of work, but by lots of job openings just closing up and going away. Right? So there are different ways for things to work out, and it's always good to consider movement in any or all of the variables, not just the usual, whatever's happened in the past most often. I agree with you. An average year, you know,
Couldn't we all use an average year next year,
yes,
all things
all
considered?
things considered,
Like,
yes.
come on, let's just do it.
Yeah.
Yes. Not, but my point in bringing it up as this idea is, you don't have to be all out of the market at this point, even if you think a recession's coming. I think being in the market in downtimes, if you're in good companies that'll reward you over time and, with dividends and buybacks and all of those sorts of things, like good quality companies that will then reward you when things get better again.
Mhm.
Um, if you have a really long term, depending on your investing horizon and all of that and your goals, I think, if you're a long term, like beyond this cycle of whatever this turns out to be, um, and compound over time, even if there's a sideways ish market, that's going to be better than sitting there if inflation's high and, your dollars are just losing value. So that's why I bring that up to be say, hey, you don't need to be all out, if you think bad things are coming. If anything, the opposite, if these companies are going to reward you as a shareholder in the next 12 months.
Well stated. All right, let's get to number 2. Number 2 is S&P 500 down 30% for the year after a blistering 50% rally off the October 12 bottom. Now that's very specific, so maybe I should explain myself. I guess what I'm saying is maybe a simple way to put it is lots more volatility, I think. That much volatility, right? Not more of what we've seen this year with the slow burn, the gradual ordered decline, but like a blistering 50% rally, maybe topping out in something like March or February, something really just, in a couple of months, 50% off that bottom, and then winding up down 30% or some crazy number like that for the year. I think that would surprise the hell out of everyone, and I think it would be terrifying. Like, they'd be euphoric after the rally, and then they wouldn't see the rest of the year coming, and a 30% decline for the year after that would be like, "Whoa." Because, if we just sort of look around, the reason I think this would be a surprise is if we just look around right now, like look at the VIX, for example, it's right around 20, it's long term average. So, maybe that's the market saying, we just kind of expect an average year. I don't think that's true. I think the average return would still surprise people, but like average volatility is a little different. That doesn't mean average return, right? So I think a super volatile year where we get, big rally up, big crash down, I think that would really just shock the hell out of everyone.
I think so too. And I think the thing that struck me when you said that was if that happens, that would be a bottom. I think at that point,
Yeah.
like that would scare a lot of people and be like, all right, well, if the market can go up 50% and then still lose another 30, now I'm out.
Yep.
And that would probably be the worst time this to sell. But it would feel like the right time to sell, but it would probably be the worst.
Right.
I think at that point. And I think a lot of people, who are in the market casually or, since 2020, that group of people, if you lose another 50% of everything, I mean, another 30%, or sorry, either one, how about 30, whatever numbers are involved,
Exactly.
you're still going to lose.
Yeah,
So
exactly.
the volatility at that point, I think, would scare a lot of people off.
Yeah, it would, people would be saying things like, the stock market is uninvestable, the death of equities, like Business Week 1979. So yeah, huge surprise
Now,
there.
why would you think the blistering rally could happen?
So my view of the current market is that looking at it as an average bear market is a mistake because I think it's one of the three great mega bubbles of the last century, the other two being the 1929 peak and the 2000 dot-com peak. And that's just according to the CAPE ratio, the Shiller, cyclically adjusted PE ratio of the S&P 500, which, got up around 30 or more in all three of those episodes. So, the current one peaking earlier this year, late last year. So if we use those examples, don't think of the current bear market as averaging, don't look at the average of all previous bear markets. Look at those huge events, right?
Right.
Which is hard to do because statistically, this is a losing argument because there's not enough data, there aren't enough examples. So it becomes anecdotal immediately and, serious. So I'm doing air quotes here. Serious people wouldn't consider it, but maybe I'm not so serious because I'm saying those are my examples. And 1929 includes a blistering rally into the early part of 1930. I think it was a 48% rally, maybe off the top of my head. But yeah, so
Got it.
yeah.
Yeah, no, that makes sense. I mean, a similar thing happened in the dot-com bubble burst. There was a huge, I can't remember the exact numbers, but there was a huge 40 or 50% rally over an extended period of time. And nobody talks about that anymore. They just talk about the bubble bursting.
Right. I mean, I've talked about this before, but just real quick, it would be normal to me, like if there was a really crashy episode in this bear market. We haven't seen it so far. I'm talking like, down 30% in a month or two or something, something really, really quick and steep.
Right.
And, it hasn't been like that. It's been the way it's been. We all know how it's been. It's just been a slog all year. Down, 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 little rally, down, down, down.
All right, so now we're ready for an average year. We're ready for an extremely volatile year. I'll go with number 3 here of our potential surprises.
Okay.
The Ukraine war envelops nearby countries, and large numbers of NATO and U.S. troops get involved. This would be a surprise, I think, for a lot of people.
Yeah.
I think people are hoping or seeing signs of this war coming to an end. Russia, more questions coming up about what they can sustain in Ukraine as far as the fighting. Ukraine getting a lot of support from the U.S. and other people financially, and basically looking like they've successfully defended their country for the most part from Russia, not without massive casualties and damage that's going to take who knows how long to recover from and what that looks like. So I think, generally speaking, you'd think after a year or so of a bloody war that it would come to an end, one way or another. But what if it doesn't?
I know.
What if something triggers? What if there's another pipeline that explodes mysteriously?
Right.
What if you could go down the list? What if Sweden, Finland? There's all kinds of possibilities get involved. That tips it into a whole nother level.
Yeah.
Yeah, that would really surprise people, and is something I can't imagine a lot of. I think it's on the minds of a lot of people, but for I think many people probably hope it doesn't happen, so they're not kind of preparing for that.
Right. This is a very interesting one to me. There's certainly a lot of nearby countries that are in NATO, right? Poland, Hungary, Romania, Slovakia. So, any war activity that winds up there, you would think that would bring in large numbers of NATO and US troops, or could. I won't claim to know about the complexities and vagaries of how war gets waged and how these decisions are made, but certainly, like if something like World War III were to break out because lots of other countries get involved, I think it would surprise. By definition, that just surprises the heck out of everyone. This is a good one. I'm glad this one's in here. All right, let's get on to number 4. And I almost didn't put this one in here, but this is just looking at what the market is saying right now. Okay, so I think the surprise is that GameStop and AMC Entertainment, the two big meme stocks, fall 90%. That'd be the surprise in 2023. And why do I say that? Well, as we're speaking here, GameStop has a market cap of more than 6 billion, which is absurd. Like even 600 million would be absurd, let alone 6 billion. And AMC has a market cap of, well, let's see. The AMC stock has a market cap of 2.69 billion as we speak. And then there's these ape securities that has a market cap of like 4 billion, so just call it seven or something, or four, almost four and a half. I don't know. Just call it seven. Okay. So $6-7 billion market caps on companies that are arguably worth zip, right? Indebted, troubled, declining, deteriorating, money losing businesses stuck in industries that are going away, you know? Why this would surprise anybody, I don't know, but the market caps tell me it would.
The market caps, yeah, no, it's a good point. We haven't had the like a credit crisis part of this yet. So all of those, not just these companies, but all the zombie companies that can't afford to pay their own interest and their own debts are going to be in trouble too. And GME and AMC are the top of the list. They might go back to when, what they were before meme stocks became a phrase,
right?
When it's all said and done, like they're down. I was just looking at AMC. It's down 80%.
Yeah,
in the past year.
Yep.
But you could still go down another 50 from there. It's not too hard to do,
right?
When you're in a situation like that.
I'm glad you mentioned the credit. Like, I just pulled up a list of AMC bonds on Bloomberg, and the prices are like, everything is below 90 and only two are in the 80s. It's like 38, 38, 28, 25, 38. I mean, that's like the market saying this will go bankrupt. You know what I'm saying? The stuff is rated like double C. It's just, it's like a whisper. It's a breath away from bankruptcy. They're just like inhaling their last breath and they're about to let it out and die. It's not looking good.
Not good. Not good for them. All right, let's move on to our next potential surprise. The Federal Reserve continues raising rates throughout the entire year. I think a lot of people would think, they're going to pause, they're going to pivot. That's what that's the narrative out there, the main narrative out there right now.
Yep.
They could keep on going. Okay, just keep on going like they did all of 2022. If inflation, sticks around above their goals, which the Fed has already said they expect in 2023 for inflation to stay above 3% by the core number that they use. They've also been wrong on all these projections for last year.
That's right.
As far as underestimating it, just the way they work, the way they share information, just the way they work. I say they're wrong because they predict out what they can in the meantime, not predictions that actually matter. It's they predict out what happens in the next 3 months and how they see things. And so they've underestimated inflation. We know that for 2 years. So why not? Why would they suddenly not be underestimating inflation and keep raising rates and say, hey, the job losses haven't piled up yet. Maybe the job openings have gone away to a certain point, maybe not all the way. And so they just keep on raising rates. And then we're in clearly in the higher rate era that we've kind of been talking about happening for the last year since everything started turning around with inflation and rate hikes.
Yeah, they're talking. I mean, they're saying higher for longer. And I'm thinking, okay, well, what does that mean? Probably what it means, and so far it has meant surprising the heck out of everybody that they haven't pivoted by the end of this year already. That was the big talk earlier in the year. Oh, they'll pivot. They won't, they can't see this through. I continue to maintain that the paradigm is like, it's a kind of peer pressure, right? The paradigm for decades was looser and looser and looser monetary policy because, gosh darn it, we are not going to allow a repeat of the Great Depression. So we're going to stimulate and stimulate and stimulate all we can. And now I think the paradigm has flipped, and it's more like the 70s, Arthur Burns and especially Paul Volcker era. And Jerome Powell is looking at Paul Volcker and saying, I want to be like Jerome. And it sounds simple-minded, but I just believe that human dynamic more than I believe anything else about this. So he absolutely, just like Ben Bernanke said, I'm not going to be the guy who lets the Great Depression happen. Jerome Powell is saying, I'm absolutely not going to be the guy who lets double-digit 70s style inflation happen. And I'm going to beat this thing back down to 2%. And what is the CPI? It's like 7. So there's a ways to go here.
There is. And then this is also, the current projections are accounting for no surprises, really.
Yeah.
It's what if the one we just talked about happens? The war gets even worse. That's inflation, inherently inflationary.
That's
So
right.
and that's going to cause all kinds of issues. So yeah, I think it's wise to prepare for these sorts of possibilities that we're talking about, actually.
Yeah. All right, let's do number 6. Number 6 falls hard upon number 5 because number 6 is simply that the CPI doesn't fall below 5%. And you could sort of pick whatever number would surprise you, and that really is the point. But at this point, there's a lot of talk about recession, and that certainly would be a year-over-year change in the monthly CPI of less than less than 5%. So I think it will surprise people, not only if, they continue raising rates, but if the CPI continues being, 5% or more. I think that would surprise it would surprise me. It would surprise the heck out of me.
Yeah, I would say 5% would surprise me too. But you look at, and I haven't done like a super great calculation on it, but the housing numbers are going to stay higher for the housing part of CPI, which makes up about a third of it. They're going to stay elevated for a while because of the way it's just calculated based on this owner's equivalent rent metric, which is basically what you would pay if you were renting your own home. And so the rent numbers are, obviously on a lag, just the way rents work in lease terms and that sort of thing. So that's going to be in CPI for a while, probably another year or so.
Yeah.
And then who knows what happens with energy prices. You got the Biden put in place for buying back oil when it gets to a certain number. So that's not gonna drag down oil prices. So and those are the two big components of CPI. So possible.
Probably unlikely, certainly a big surprise. All right. So what do you got for number 7?
Number 7, Bitcoin. How could we not talk about Bitcoin? Now, when we got together to talk about these, you had Bitcoin falls below $5,000, and I said a surprise would be Bitcoin at new all-time highs. I'm willing to bet a lot of people would be surprised at all-time highs, and I think you would be too, because when I said it, you smiled and and said, "Whoa." My point there is, and 5,000 for I think maybe some people think this FTX debacle is it. That's the bottom of the crypto sell off. This is it.
Right.
That's the bottom.
Yeah.
I think. To me, the reason I said crypto all time highs would surprise people is to encourage people who might still own Bitcoin, Ethereum, that things could get better in 2023. I mean, we've seen this through Bitcoin's cycles of peaks and valleys. I mean, a drawdown from 60,000 to where it's at now is around 15. That's pretty big. I mean, and when you look back at the history of Bitcoin and the previous spikes and bubbles, I mean, I personally wouldn't see it going much lower. So if you're holding Bitcoin, I would say keep holding on to it as a long-term kind of well, if that fits your goals, hold on to it long term and see what happens this next year. Because right now it's can't have more bad sentiment around crypto in the mainstream world, at least.
That almost sounds like famous last words, but I agree. Like, certainly, just even anecdotally, sentiment, can it really get much worse? I don't know. I guess it always can, right? It can always surprise you, which is the point of this exercise. But that is a point very well taken. I think it's interesting. Like, I have to say, You pointed out that my surprise was below 5,000. Yours was new all-time highs. Yours strikes me as really the superior surprise. New all-time highs from wherever we are, around 16 grand or so, after falling from 69 or whatever it was. Wow. That would be a major surprise. And I'll tell you what, you could imagine it happening. We did have Mike McGlone from Bloomberg on the show, and he was talking about Bitcoin no longer behaving like another speculative tech stock, falling and rising with the Nasdaq, mostly falling this year. And I've heard other people suggest the same thing. It decouples and becomes more of an inflation asset, a risk off type asset. So far, we haven't seen it, but I'm just trying to posit a scenario under which maybe some of these other bad surprises happen, yet Bitcoin does go and make new all-time highs. But yeah, it surprised the hell out of me.
I think a scenario where along those lines where it could happen, since I didn't really say and give any good reason for it, was, say a situation like we were just talking about with the Fed, that they do cut rates and people get all scared about inflation again and just central bank mismanagement. Bitcoin can kind of get some more wind behind its sails again, and crypto and as more of like a anti-central bank kind of play that more than anything.
Right. Yeah. At some point, you would expect maybe even all the meme stalkers, if they have any money left, they could turn completely anti-Fed, because maybe they're the same people, I would suspect, who bought the ARK Innovation ETF. They're down 80% on that one, and they hear Cathie Wood blaming the Fed for it. And
Right, that's
they
true.
even maybe they bought Tesla, and they've heard Elon Musk saying a few words about raising interest rates hurting Tesla stock. So then maybe they pick up on that, and they become a thundering herd of Bitcoin buyers because they hate the Fed now. That's their main thing. They don't want to cause the mother of all short squeezes in meme stocks anymore, and they don't want to buy Tesla, and they don't want to own ARK anymore. But now they're going to hate the Fed, and they're going to buy Bitcoin and have BTC with little rocket emojis on Twitter and stuff about that. And maybe that causes a big spike to a new all-time high. I mean, I'm almost wanting to go out and buy some Bitcoin.
There you go.
All right, let's move on to number 8. Of course, the point of the surprises are extremes, right? And it's funny that we started out with an average S&P 500 return, because that would seem extreme to some people at this point. But the next one, number 8,
Right.
is mortgage rates either above, I'm going to say 12% or below 4%. Right now, I don't know what you call it, the bank rate national, it's actually the bank rate national average, which they publish, is around 6.6%, just say. And if the Fed has said they're going to keep raising rates, so we know that's going to happen. We don't know it's going to happen all year, like the surprise that we just put up, but we know rates are going to go up. But from 6.6 to 12, no, nobody's thinking about that. Nobody's thinking about double-digit mortgage rates. And that may seem like the bigger surprise, but given that the Fed is going to continue to raise rates, below 4 would also shock the hell out of anyone.
Yeah, I'm with you. Those are the two extremes right there. 12% rates. Wow. That would that would be I know a lot of people have experienced that sort of thing from their first homes and when they bought first homes, and to me that's always how could people afford that today? I'm not sure. And that would be the sign of a terribly bad recession happening. And 4% would be, I guess, the optimistic scenario in the in the equation.
Yeah.
We're not going to go down much lower than that, I would think, anytime soon. So,
Right.
yeah, the housing market is definitely, I think, what this question is getting at is what we'll be watching a lot this year to see how that develops. Because, as we've said, there's the long term fundamentals for housing and residential housing are there. Will the demand be there? And the desire of companies to build new homes remains to be seen. We will see.
We will. I want to throw one more thing in here. I saw on Twitter, I think it must have been on Twitter, because it was a guy posting a picture of maybe it was an email that he had gotten about his adjustable rate mortgage. Remember those? They were lots of fun during the housing crisis.
Oh, yeah.
And he had started out with this adjustable rate mortgage at something like 2.85%. And he was showing an email from the mortgage company that said, your new rate, and he had gotten a bunch of these, and his latest one said, your new rate on your adjustable rate mortgage is 6.1%. And he started out with like a $2,500 or $2,800 mortgage, and now he has like a $4,200 mortgage. I mean, the brutality of that. I'm not looking.
Yeah, the amount of debt that will pile up because of high mortgage rates,
Yep.
I think is the it's the thing to watch from
Yep.
that because people would pay however they can, and most of the time that's going to be on a credit card or something.
Yep.
So yeah, that would be a spin cycle that I don't think any economy wants to get into.
Yeah, you're right, though, too, to point that out, because two of the data points that I'm constantly seeing in places where I, just get a lot of data from various services are lower savings rates, like people depleting their savings, and higher credit card balances. So, just higher rates all around, boy, it would really stress people out.
Yeah, one more thing on that before higher rates, higher mortgage rates, more debt, interest you pay on that debt is higher, and on on and on it goes. It's like for the individual, you could see why inflation is ultimately a terrible thing, high inflation.
Oh, yeah.
So we have everybody to thank for that. All right. Let's move on. Number 9, speaking of inflation, our next surprise, gold. Below $1,000 an ounce or above $5,000 an ounce. This is a good one. I'm glad this is on here because I feel like a lot of supporters of gold have been waiting for it to break out because of inflation. And we saw that in 2020 when it became clear that we were kind of going to have inflation based on what the Fed was doing and fears of inflation. I think that was warranted. But then since then, it's just kind of no joy for gold holders. But I think the big one, it's around $1,800 an ounce right now. With the dollar, I think I like to look at it in the context of the dollar. And if the dollar is going to get a little bit weaker this year compared to, um, the euro, the yen now, actually, there's a lot of reasons for gold to go higher just from that perspective. If the dollar is getting weaker, gold should go higher. Now, a lot of these surprises we've talked about have been maybe the dollar keeps getting stronger. But even if the Fed keeps raising rates and strengthens the dollar, maybe some of these other countries will be raising rates at slightly higher rates or, that sort of thing where the dollar overall keeps weakening. And so in that case, gold, then silver and the hard assets, anything priced in dollars should have a good time in that situation.
Yeah, I'm glad you mentioned other currencies too, because that really is the point. Like year to date, as we speak here, gold is about flat. It's almost flat. It's like down less than 1% in dollars. Okay. In Japanese yen, it's up 14%. In euros, it's up 6.5%. In British pounds, it's up 11%. So, it's interesting to think about the same asset from the perspective of what it's priced in, right? Like you can own
It really
dollars
is.
and
Yeah.
you can own gold because you're thinking about gold being priced in dollars and you're thinking about dollars being priced in those other currencies. It's sort of, I think this confuses a lot of people. So that's all in the general direction of maybe we get above 5,000 an ounce and maybe that will surprise people. We go the other way and that's your like extreme sort of recession scenario with gold going below 1,000 an ounce and nobody believing it's a good inflation hedge because of the way it's behaved this year, even though they're just not looking at it in those other currencies. I mean, you know, of course it's up 11% in British pounds, like British inflation. is 10.7%. Just go right on the Bank of England website. It's like huge letters. You can't miss it. First thing, top of the page, middle of the page, 10.7%. So, of course, like gold is up 14% with Japan inflation, Japan CPI at like 3-ish. Seems to make less percent, but it's like up, right? It's doing its thing. And it's doing its thing in euros too. So eventually, those weaker currencies relative to the dollar looks like a strong dollar. People say, "Oh, I don't want to own gold." No, 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 no. Dollar can be weaker relative to gold, so you want to own them both.
Right. Yeah. Yeah. No,
Yeah.
it's a game within the game there as far as the currencies relative to each other and relative to gold. A lot of times people get wrapped up in the home country bias of just thinking about things priced in whatever country they're in. And with gold, the gold situation is something I realized early on was when I got into this was exactly what you're talking about. Like as far as the gold price moving differently compared to depending on what currency you're comparing it to, which is really obvious in this case with the dollar because of the strong dollar trend. But when that turns around, boy, like like you're saying, if gold's been rising in these other places and then the dollar weakens, like there you go.
Right.
Gold party.
Right. And to be fair though, like the Dixie index is, it's mostly euros, and then it's also Japanese yen and British pounds and maybe a few other things. But those are the three big ones. And lately the dollar has weakened. That index has weakened, and it got a
That is
big
true.
shot
Yes.
last week when Japan sort of made this bizarre surprise announcement. It surprised the hell out of the bond market, and yields went up, right? And the yen strengthened relative to the dollar when they announced that they were going to widen the target range for the Japanese 10-year bond from 25 basis points on either side of zero, literally from negative 25.25% to positive 0.25%. They're going to widen that to 50 basis points on either side of zero, right? So they're still at zero. They're just widening the range, and the market took it like a rate hike, which the Bank of Japan was no help because they previously said, yeah, if we widen that range, you should take it like a rate hike. And now the rhetoric is, well, no, it's not really a rate hike. So
yeah, well, whatever you want to call it, they haven't done this since the late 1990s.
Yeah.
Raising this rate. So it's been you think we've had low interest rates.
Yeah.
We got nothing on Japan for since the 90s. So
Yeah.
it is a big deal from that perspective. And it made me wonder about what's going on there with inflation and the number our Newswire editor, Scott Garlis, told me they look at a core number because they import so much and don't export as much as they used to. And that number has gone above 2% for the first time since 2015.
Yeah.
So they're starting to feel inflation too, which I wonder if this is a reaction to that.
Right. They are also the single most indebted nation on earth with debt of 260% of GDP. And I think the next most indebted is like Greece or someplace with less than 200%, like, maybe half of what Japan has. So they really don't, like, you can understand why they have suppressed rates and continued with more dovish policy right up until this moment, versus every other country in the world which has been raising rates, all the big ones anyway. So it's an interesting and epic struggle, I think, playing out. It's the epic struggle for 6,000 years. I mean, there's literally a story of some Greek guy, I forget his name, but it was like 6,000 years ago, and he said, "Well, let's see, I've got a lot of debts here, and I don't have enough money to pay them." So he ordered everybody in the country to turn in their coins on pain of death if they didn't do it. They all turned in the coins, and they were like 1 drachma, right? And so he stamped them all 2 drachma and had plenty of money to pay off all the debts. Of course, history doesn't tell us what happened, but everybody probably like more than doubled the price of everything, right?
And we've been doing it ever
Yep,
since.
we've been doing it ever since. It's the age-old struggle, like the debt market and the banks versus the currency. And the currency, as in that example, the currency always loses eventually. So this strength in the yen recently, I don't know. The market took it as a rate hike that strengthens the currency, and it was at that critical level of like 151 to the dollar and strengthened into the 130s now, and I think into the
Yeah, if the yen strengthens versus the dollar, to bring this back to
Mhm.
gold, that should help gold a bit to silver with a weakening dollar. So
Right.
we can play that game. There's all kinds
Yeah.
of different inputs you can weigh
Yeah,
there
it's
that will add up to the dollar the dollar
yeah,
value.
it's
But
3D chess, man. Yep.
yeah.
All right. Are we ready for big number 10? I think we might be.
I'm ready. Let's do it.
So, number 10 is like I'm gonna put this on the list probably for the rest of my life because it's probably never gonna happen. And it would certainly shock the daylights out of absolutely everyone, but it's like my pet surprise that I'll keep writing about forever. And it is simply essentially a repeat of October 19th, 1987, when the Dow Jones Industrial Average lost 22.6% in one day. And the surprise would be, I'll say this time the S&P 500, not the Dow, down more than 20% in one day. And the main reason that'd be a surprise is not the size of the move, but the institution of circuit breakers. One of the things that came following the 1987 one day crash was the exchanges all use circuit breakers now, which means like if the S&P 500 falls 7% or more during one session, they stop trading for 15 minutes. Then they start trading again. If it falls, the next one is 13% that day, stop for 15 minutes. Then they reopen trading. And if it falls 20%, they close the exchange. So naturally, people say to me, Dan, they close the exchange when they're down 20%. How could it fall more than 20%? My perspective on this is not technical. Lots of people know a lot more about how circuit breakers work and how the electronic market works and everything than I ever will. My perspective is philosophical because I think that, and we talked about this on a recent episode too. Just philosophically, I think that people don't create markets. Markets happen to human beings. We are in markets the way fish are in water, and the fish don't control the tides or the wind or the waves or the currents or the temperature or any of that stuff. And I don't think humans have the kind of control over markets that they purport or that many people believe. Like the Fed, they think the Fed controls the market and can make it go up and down by lowering or raising rates. And I don't think it works that way. I think that the market is going to do what it does. It's extremely complex. It's not 3D chess, it's a million D chess every day. And there are too many inputs. It's too complex. We can't control it. We can only participate in it. And I just refuse to believe that they have so much control that they can stop the loss right at 20%. Like there will be what if there are just a gazillion bids and asks below minus 20% on the day? Circuit breaker or not, there's a market down there being made. And I don't think it's going to go away just because they close the exchange. And even if they can close, I don't even know for sure that they can always definitely close the exchange quickly enough. Will it be down 20% exactly and it's closed, or 20.5 or 21% or something? I don't know, but I'm skeptical of it to say the least. You must admit this would be a big surprise, right?
I think it would be a big surprise to enough people. The the circuit breakers thing. I mean, honestly, you know more about it than me as far as how that works, and I don't know much about it. All I know is that they're there, and people seem to trust them,
Mhm.
and that so is maybe a mistake to think about. That a mistake can be made there somehow. We've seen all kinds of hacks and everything
Actually,
else, and
Corey, you make a great point. The fact that everyone trusts it is why you need to be skeptical. I'm glad you brought that up. That's exactly the point. Everyone thinks there's
right,
no way
yeah.
it can go wrong. Oh boy, that can't be good, right?
Right. We saw this during the COVID crash, those circuit breakers were tripped, I don't know, 3 or 4 times
Mm.
in a week, I think, and the market was still down, went down 20-30%. So, even if even if they are in place, I think a lot of people that the COVID crash took a lot of people by surprise, how the speed of that, right? We
Mhm.
were all talking about how quick that was. So even with them, you can still, you don't know when the circuit, like the average investor doesn't know when this circuit breaker is going to hit. You don't know that unless you're really involved and really looking at things, and even then you don't
Right.
know. So the point is, these surprises. That's why they're surprises. They can happen, and they do happen. Now, what this also made me think about was there's no circuit breakers for individual stocks. That maybe at some level you get to that point with certain, you halt trading on certain stocks, but generally speaking, if Facebook goes down 10%, 20%. Now, this isn't like a huge, I'm not talking about like a massive flash crash where you would halt trading or something that would stop trading. I'm talking about just like a surprise where, hey, this is like you've said before, the big tech stocks, big mega caps, or can lose a lot of money
Mhm.
in a short period of time, which I don't think a lot of, and so that's when we see when Netflix loses however much after earnings, or Facebook
Mhm.
loses however much after earnings. That's like big news. And so, and then that takes a lot of people by surprise and scares a lot of people, and volatility. So those things can happen, is my point.
Yep.
There's maybe if it's not even at a flash crash level, it's close enough for you. And plus, as we've been talking about this, I was kind of thinking about, there's so many stories about how out there, and I couldn't remember the exact one from this past year, or maybe it was last year, where like somebody typing in a 1 decimal point in the wrong spot on a trading desk causes all kinds of billions
Yeah.
of damage.
Right.
Those things
Yeah,
happen.
that's
They
the fat
happen.
finger. That's called the fat
Yeah,
finger.
the fat
Yeah.
finger. Yeah, don't get your decimal points in the wrong spot.
Yeah.
And so, there's still people behind all these computers.
Mhm.
So as long as people are around,
Yep.
we'll have people problems. So that's and people good things, but
Sure.
there's the human element still in all of this.
Yep. So, essentially, like, what we're saying is these things are viewed as highly unlikely by lots of people. It seems to us at this moment, based on the data we look at, it seems like these things are viewed mostly as highly unlikely by a lot of people. I wonder, one of the things that I like to write about in the digest each week is things that are admittedly highly unlikely, and this whole list is, but which are more likely than anyone believes. It can still be unlikely, you understand what I'm saying? But has a higher probability of occurring than anyone believes. So if I don't know, if you could pick one or two or however many you want to pick that you thought were, these are still unlikely, but if you thought they were more likely to actually occur, what might you pick? I might pick the first one, which is, average return for the S&P 500. I think that's more likely to occur than most people think. But the other ones, I just look at them, I think, well, they're highly unlikely. They'll surprise the heck out of everyone. Do you have one that you think would be more likely than most people think?
Yeah, I guess in a way, more likely would be my first one, which I thought would be most surprising, which average S&P 500 return, which by definition is kind of
Yeah.
average. So yeah, maybe that's more likely than we think. Given the amount of volatility that people are expecting ahead. Yeah, that one
Yeah.
would be more likely, but yeah, maybe honestly, I would not be surprised at all by your one about the S&P having a blistering rally and then, losing another 30%.
Oh,
That would not surprise me.
yeah.
Actually. Yeah, no,
Really?
I think the way
Wow.
things are going with inflation, I think those numbers will come down and lull a lot of people into that part of the story being over, which I think might
Mhm.
already be here. But then, like I think a recession, any kind of significant recession, I think can cut that down by the end of the year.
What about, like, another way to ask this question would be, you know, you gotta bet real money on one or more. Which one do you pick then? I mean, the average S&P 500 return is like not a bad
Not a bad bet.
one to bet real money on,
Right,
right?
yeah. Yeah, no, it's or your idea too. I mean, if you're paying attention to it, you know, if you think there's going to be a blistering rally and then you see signs that things are breaking down, you know, you might not time it exactly, but you'll enjoy some upside and hopefully protect yourself from most of the downside. So if
Yeah.
you're able to follow the indicators that lead you in the right spot, but yeah, I would, you know, I would say I think I would bet on not being all out of this market, but being, you know, choosy and specific on what you put your money in this year. You know, you always want to do that, but as opposed to, you know, a long bull market, this isn't a long bull market. So you got to be a little more deliberate with what you do.
Yeah, so I might also bet on number 4, uh, GameStop and AMC Entertainment fall 90%. If you do it in the right way, if you just short the stock, you know, you can be 1/10 right and still, you know, you'll still do fine. You can be half right, and that'll be a fantastic result,
Yeah, yeah.
right? So you could do that. And also, like, gold, well, we said the surprise would be an extreme move in gold, below 1,000 or above $5,000 an ounce. I don't mind betting on the above 5 just because I own gold, I'm gonna stay long anyway, but that's all I got for a real bet. I'm not betting on any of the
Well, I
others,
bet
man.
maybe with the mortgage rates one, if you're in real estate or residential with
Yeah.
your own home, you know, if you have a rate that's
Mhm.
below 4%, and we think the best case scenario might be rates going back down to 4%, you know, stay where you're at with
Yeah.
that, or stay where don't try to sell your house if rates are above 12, you know, above 12%, buy it, you know, don't be moving this year, I guess. And that's something that I think speaks to the real estate market, that might speak to the real estate market eventually throughout this year.
Yeah, I was talking to my wife the other day, and I said, "You know, one of the regrets I have in life is not borrowing enough cheap fixed rate money." Well, I wasn't always like when I was younger, I borrowed more and I really got in over my head, but as an older man, I've been, you know, making the opposite mistake, I think. And I've always been like we had one house that we lived in paid off. I paid off the house like way ahead of time. You know, it was a 30-year mortgage. We lived in the house. I think it was paid off within like 8 or 9 years or something, maybe less. And I thought, "Oh, that's really great." And it was, and I'm actually still proud of it, but and I'm this is hindsight too. This is 2020 hindsight. But you know, there's something to be said about cheap fixed rate money for 15, 20, 30 years. It can be a very good thing, especially in a fiat currency system. What do we know? What is guaranteed to happen to the value of that currency over time, even if it's only at a rate of 2% a year, right? Even if the Fed gets us back down to 2%, there's always inflation. You know, your money is always losing value. So paying back in cheaper dollars in the future at a fixed rate is like it's kind of a no-brainer. I'm not telling people to run out and go and get a bunch of fixed rate debt. It's just a personal thing where I'm looking backwards and I'm thinking, well, what if the CPI doesn't fall below 5% and I can, you know, borrow against the house at whatever it is, 7 or 8 it would be, I guess now. I mean, that's 2 or 3 real,
Yeah, it's
you
certainly
know,
better
at some
than
point.
what we were talking about before with the adjustable rate mortgages. Yeah,
Oh,
that's
yeah.
ooh,
Whole
yeah,
different ballgame, yeah.
that's
Screw
tough. Yeah.
that. Screw that. Not doing it. Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. But they worry it's about to get even worse. And many of the things you take for granted are due to a big disruption in the months ahead. Your Social Security benefits will likely be slashed, your taxes are probably going way up, and many of your investments are likely to continue falling. Meaning, if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning totally free today. It's all spelled out in a free report we've put together about the great unraveling. Get the facts yourself. Go to www.2023unraveling.com to get your free copy of this report. You can learn how to get their full playbook to prepare for what's coming. Again, that's www.2023unraveling.com for a free copy of this new report. All right, well, maybe I should once again turn our traditional final question from the interview on each of us and ask if we could leave our listener with a single thought today. What might it be?
Do you want to go first this time, or am I up again?
Okay, fair enough. I can't do better than a couple of mantras. My traditional one of prepare, don't predict. These are not predictions. They're things that we think would surprise the market. And you must, I think now more than ever, the world has changed. It's no longer the continually ever looser monetary policy, rates going down, valuations going up environment. And you need to embrace that and understand and prepare for it and own plenty of cash and some gold at the same time and be careful of what stocks you own. It's a 3D chess game now. And that monolithic buy the dip strategy that everyone used for the last 40 years is over. I think the 60-40 portfolio is over. So take that information, embrace it, embrace the prepare, don't predict mantra, and do as our previous podcast guest, Brent Johnson, said, survive in advance. And I think survival, the people who are worried more about capital preservation and survival and preparing for what's to come, preparing for many different scenarios, are actually going to do more than survive. They're going to earn the good returns. That's my final thought.
Cool. Yeah, that was great. In the spirit of this episode, too, I'm going to say expect surprises. You don't know what they're going to be specifically, but surprises happen, or at least that people call a lot of surprises happen. But at the same time, when you look at history and human nature, a lot of stuff that we think are surprises have been done plenty of times before. Pandemics, crashes, rallies, fear and greed. So it all of this is not, we've talked about like specific things that are new, that may be new for today, but a lot of this stuff, I assume if people were doing a podcast 500 years ago or 2,000 years ago in the forest somewhere, they might be talking about similar sorts of things with what's going on with this animal and and who's the bad hunter and who's the good hunter and those sorts of things. So my point is, all this stuff we talked about today is good to think about these ideas when it comes to like the portfolio in 2023. But there will be other things that happen, and you just got to make sure you're protecting yourself while also, not being out completely and being smart about it and risk managing and to the best of your ability. And that's all you can really do. You don't know what's going to happen, but something will happen.
Well said, sir. And that is another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.